All right, activity ratios. Activity here means operating your business, doing things, selling stuff, inventories, that kind of thing. So we're going to look at a lot of these are about managing your current accounts, inventories, receivables, payables, that kind of thing. So these are best served by example here. You can see the formulas here. Remember, for balance sheet items, we're going to take averages. For income statement items, we're not. Most of these are an income statement item divided by a balance sheet item. So you'll have to average that balance sheet item, but not the income statement item. All right, another thing I want to mention here is these are often talked about in terms of days. And I remember being a student that bugged me because I was trying to memorize these ratios, and I had another ratio to memorize, those days, sales and receivable, or days and inventory, and that kind of thing. But just realize that days is always just the number 365 divided by the appropriate turnover. So if you want days sales receivable, well, it's 365 divided by receivables turnover. If you want days in inventory, well, it's 365 divided by inventory turnover. Right? So days anything is 365 divided by the appropriate turnover. Right? And so I've got these formulas here, and they're just looking at, how long does stuff sit in inventory? How long does it take you to get paid, to get your receivables paid? How long does it take you to pay your payables? That kind of thing. Okay? And so I've got these formulas here, and you can just use those formulas and just look at that. So yeah, best served by an example here. Let's do some calculation here for Home Depot and Lowe's. I've got, let's just calculate inventory turnover to start with. So we'll go to my spreadsheet here and we'll calculate inventory turnover for Home Depot and Lowe's. Now remember, inventory turnover, we're going to start with, it's the cost of goods sold. So from the income statement, cost of goods sold for 2018, and I'm going to divide by the average amount of inventory using the number from 2018, 2019 balance sheet, right? And I've got inventories up here. I'm sorry, 2017 and 18, right? Get the 2018 number. All right, so I've taken the cost of goods sold from 2018 divided by the average inventory over the year, and that will get me a number there. And let's see, I've got that in the wrong place, so I'm going to do that again. I'm going to take the cost of goods sold number. One thing I mentioned here is that remember that when you sell stuff, the way I think about it is when you buy inventory, it goes on the balance sheet. You buy stuff, it goes on the balance sheet in the inventory account. So I paid $1,000 for some stuff, put it in inventory, that shows up on my inventory account. The way it gets off my balance sheet is through cost of goods sold. I sell it, and then it's recorded as, oh, well, what was your cost of goods sold? Well, I had to go out and buy these items for $1,000 and put them in inventory. Right? So that's why we use cost of goods sold. That's how you get rid of inventory, is through cost of goods sold. Right? So this is just measuring, based on the amount of inventory you have during the year, how much of it are you selling? All right? So take cost of goods sold and I'm going to divide by the average amount of inventory here over the year. And I get 5.31. Right? And so that says, basically 5 times a year you're selling the amount of inventory that you have, which is good. It's just kind of saying, and a lot of this, the valuation of this number, or the value judgment on this number, depends on the business you're in. If you're selling a very complicated item and you make 4 a year and you sell 2 of them, all right, that's a different inventory turnover than if you're like Home Depot, where you're selling hammers and nails and stuff, not real complicated items. You're just trying to get them in and sell them as quickly as you can. Right? I'll mention here too, we often look at this as days in inventory. Remember I said all days are just 365 divided by the appropriate turnover. Right? And this says 68.72, and that just says on average, an item in Home Depot takes almost 69 days between when it's purchased and put in inventory until it's sold as a cost of goods sold. Right? So you can think of it as sits on the shelf for about 69 days on average. Right? And so we can do the same calculation for Lowe's. do those same calculations for Lowe's, the numbers are 4 and 90. So again, if we're going to make a value judgment here, in this case, it looks like Home Depot has a pretty significant advantage. They're selling stuff a lot faster, right? Which that's the whole business here is they buy stuff, put it on the shelf, and try to sell it, and they want to move this stuff out as quickly as possible. And stuff is sitting on the shelf a lot longer. It looks like an extra about 20 days at Lowe's than it is Home Depot. Okay, so that's inventory, days inventory. We can also look at asset turnover here, which is a measure of the efficiency. The way I think about this ratio is I went out and bought all of these assets to make my business. I mean, that's what my business is, all the assets that I own. The reason I own those is to sell stuff, to generate sales. And so this ratio is just telling me that, hey, for the assets you have, how good a job are you doing at turning those into sales? All right, I've got the question here, would you like this to be big or small? Well, big as possible. Right, I'd like to spend $1 in assets and generate $40 billion in sales. That would be nice, right? So I'd like it to be, I really want to make my assets, put them to work and have them generate as much sales as I can. Right? That's saying I'm operating very efficiently. For the investment I've made in assets, I'm generating a lot of sales. Okay. Going along with that, we have returns, rates of return that we can calculate. And this is saying, okay, for the investment you've made in your assets or for the investment you've made in equity, the investment that your equity holders have made in your company, how good a job are you doing at returning income to them? Right, so return on assets is this earnings before interest. It just means the money you make before you pay the interest to your debt holders, right? Divided by the average amount of the average total assets. And then, so this is debt plus equity because it's assets. And then if you just look at your equity holders, it's the income you make divided by the amount of equity. So based on the investment you got from your shareholders, how much income are you returning to them? All right, I've got this important sticker here because these are very often considered kind of the bottom line of companies. That's why you're in business, is to generate a return for your investors. And so these are very important numbers. And if you're a manager at one of these companies, you're going to be judged. It's kind of the bottom line here. You're going to be judged on these numbers. Are you generating a return on our investment? Okay. All right, so we can calculate these for Home Depot and Lowe's. So let's just go do that here. So for asset turnover, remember that's sales divided by assets. So sales is an income statement item, and I'm not going to need to average it, but assets is a balance sheet item, so I'm going to average it. Okay, so sales divided by the total assets, which is here, and I'm going to take the average of 17 and 18 numbers. All right, and I get 2.44 for Home Depot, and if I do the same calculation for Lowe's, I get 2.04. So again, slight advantage to Home Depot. For the amount of assets that they have, Home Depot generates a slight amount more sales per dollar investment in assets than Lowe's does. Not a huge difference there, but small. Right now I'm going to calculate the EBI profit margin, and this EBI stands for earnings before interest, and it is just, I think I have it on this slide here, it is just the net income plus the interest expense times 1 minus the tax rate. So you're just taking the net income and you're adding back the interest expense, because that interest expense is paid to the debt holders who financed these assets. Right? Your assets are financed with both debt and equity. So what you're saying is okay, well, I'm going to take a net income goes to the equity holders, the interest expense goes to the debt holders, so I'm calculating the total amount of money I'm making to repay all of my investors, and then dividing by assets, because debt plus equity equals assets, all right? Okay. So now there's this times 1 minus the tax rate, and there's technical reasons why we do that. That is not that important. The concept here is that you're just adding back the interest expense because You're looking at the return on assets, which includes the investment from the debt holders and the investment from the equity holders. And the reason we do this 1 minus the tax rate is because when we calculate the weighted average cost of capital, we take the after-tax cost of interest, the after-tax cost of debt to come up with that calculation. And it just makes all the math work right. All right, we multiply times 1 minus the tax rate here. So it's kind of a technical reason there that we can talk about more later when we talk about the weighted average cost of capital. But don't get too caught up in that. Realize you're just adding back a measure of the interest expense that you're going to pay to the debt holders, and the net income represents what you're paying to the equity holders. Okay, so I'm going to do that calculation over here. I'm going to calculate the EBI profit margin. I'm going to calculate the net income, and I'm going to add back the interest expense, which is right here, times 1 minus the tax rate. And I'm putting back the tax rate here. Yeah, just assuming a tax rate of 30%. Right? And so that's the EBI, and then I'm going to divide that by the total assets, which is an average. Oh, I'm sorry, profit margin. So that's EBI profit margin. I'm going to divide that by the amount of sales. Okay, and that's 10.96. So that says that for every dollar of sales, after you paid all of the expenses, the money you had left over to pay your investors was almost 11%. So you sold a bunch of stuff, you paid a bunch of expenses, you've got 11% of it left to pay your investors, both debt and equity investors. Okay? And then I can calculate ROA, which is, let's see, I think I have that. First, let me make this Lowe's calculation here. For Lowe's, the EBI profit margin is much lower, 4.16%. So in this case, if you're looking at a value judgment between these two companies, you would say certainly for 2018 at least, Home Depot had a much better return on its assets, much better EBI profit margin here. They have a lot more money left over after paying their expenses than Lowe's does, right? So yeah, that's the first one where there's quite a difference there. Okay, and then I've got some slides here where we'll talk about the return on assets, right? So return on assets is the EBI divided by average assets. So it's the amount of money that you have after paying your expenses available to all of your shareholders, all of your investors, divided by the total average total assets. So I'm just going to calculate that again. I'm going to calculate this earnings before interest. I'm going to take the net income. I'm going to add back the interest expense times 1 minus the tax rate, which is 30%. And then I'm going to divide that amount by the average total assets. All right, I get 26.79%. And if I do the same calculation for Lowe's, I get 8.51%, much lower return on assets for Lowe's than for Home Depot. Right? And yeah, the question is if you look at these two, you say, wow, boy, Home Depot is really doing a much better job than Lowe's in generating income to return to its investors. You might say, well, why is that? And one way we look at that is that we can write this return on assets a different way. So here's the general formula: net income plus interest divided by after-tax interest divided by average assets. But we could also write it this way, which is net income plus interest after-tax interest divided by sales. Now that gives me the profit margin, right? What we call the EBI profit margin. So it's saying, look, after paying all your expenses, but before paying your interest, what percent of your sales you have left over to pay your investors, right? And then I'm multiplying this times sales divided by assets. And if you remember, this is the asset turnover. It's saying, well, how good a job are you doing of managing your assets and turning those into sales, right? So I've got two things going on here. The EBI profit margin says something about how well I manage my expenses, right? Because I make sales and then I pay all my expenses, and whatever money I have left over is available to my investors, and that's measured by this ratio here, the profit margin. And then the asset turnover says, okay, well, for all the investment you made in those assets, how good a job are you doing at turning those into sales? Right, so how well am I managing my assets? Notice if I multiply these two together, the sales will cancel, and I'll be left with this ratio here. Right, which when I first saw this, I said, well, that's pretty silly. I could, they just cancel those things out. It doesn't seem like much high-powered math to me. But you're just breaking this down into two parts. One says your ROA is composed of these two components: managing your expenses and managing your assets. And so if you have a problem, it gives you an idea of where to look. So if your ROA is too low, as it is with Lowe's in this case, it gives you an idea of where to look. And if we look at these items in Home Depot versus Lowe's, you can see that the asset turnover, while Home Depot's better, it's not enormously better than Lowe's for asset turnover. But look at the profit margin. Home Depot has a much more than double the profit margin than Lowe's. And so if you were looking at these two companies and trying to say, or if you, let's say you were, an investor at Lowe's or a manager at Lowe's, and you're saying, why are we getting beaten by Home Depot here? Well, for 2018 at least, they did a much better job of controlling their expenses. So if this is a trend that's been long going, you would say, man, we've got to get our expenses under control. Obviously, Home Depot is the same kind of business we're in, and they're doing this at a lot less expense than we are. So we could have a problem here with managing our expenses, and we need to look at that. So the reason why Home Depot had a much better return for investors than Lowe's in 2018 was because of this profit margin. Okay, and that's another thing I'll mention here is that if you look at these two companies for 2018, and in virtually every case, for every ratio, the advantage goes to Home Depot. So if you were an investor, particularly if you were an investor at Lowe's, you would say, the management needs to pick it up here. Obviously, you're able to manage a company in this kind of business better than you guys are doing it. And they're generating much higher return, Home Depot is, a much higher return for their investors. So you would not be happy if you were an investor at Lowe's looking at these numbers. In every single case, Home Depot has the advantage. Okay, so that's a look at those ratios and just a set of those ratios, examples, and a value judgment there on Home Depot and Lowe's.